David Kuo is co-founder of The Smart Investor, and Louise Loo is a lead economist, China at Oxford Economics, joining us around the desk for this four-way discussion as we see more lines coming in from that two sessions underway right now, the National People's Congress, that is. Good morning to both of you. Lovely having you on the show just the day that we need your perspective. David, let me start off with you. What is your own sense from all that's come out from the NPC?
Well, first of all, I think the 5% is fantasy anyway, the 5% GDP growth from China, because I just wonder, where is the 5% going to come from? I mean, I'm not an economist, Louise is, but from what I understand about economics, an economy grows through consumer spending. It grows through private sector spending, government spending, and exports. And if you have a look at those four levers, those four drivers, consumer spending is non-existent. Government spending, sure, the government's going to spend on what? And then private sector spending, well, what are they going to invest in? And finally, net exports. I mean, that leg has been kicked away. So what are you left with? Nothing. And so how are you going to get that 5% GDP growth?
What do you think? I mean, Sri just said a moment ago, it's really largely symbolic, but then what's the point?
I think that's right. I think a lot of the alternative estimates of growth have got growth growing at closer to 3 or 4% last year. But I think that speaks to the policy mindset of stability, right? Really wanting to anchor confidence at a time when confidence is just so weak. They've tried 2 years to raise confidence. I think in an alternative realm, if they had come in with a lower growth target, I think that would have precipitated a lot more challenges down the road. So I think this is perhaps a symbolic move to show that policymakers are going to focus on keeping everything stable, including the currency, including growth, including consumer spending, including their commitment to fiscal stimulus. And I think that is probably welcome news, even though it's highly well signaled and everybody on the street is probably expecting a 5% growth target.
Are they throwing good money after bad, though, Louise?
Yeah, well...
The second question, the $64,000 question is, will they achieve the 5% growth on the 31st of December 2025?
With a last-minute little stimulus push like they did last year.
Exactly.
Got to get it over the line.
Yes.
Who is going to say we're not going to get 5% growth?
No, she makes a very important point. At the end of the day, they always get across the line by that last dose of stimulus.
It happened in 2023, it happened in 2024.
By the skin of their teeth.
So there is that last-ditch policy. And because it's last-ditch, they have had to resort to measures that are immediate, like trading programs, stepping up on that. We know that those have immediate impact. They have had to resort to things that are, a bit unconventional, just so that it filters through to the economy quickly, right? Investments
they
obviously
need more durable policies, don't they?
Yes,
do we think we're going to get anything durable out of today?
Well, this really isn't a platform for implementation, right? So implementation is kind of the platform for us to read the tea leaves and see where the policy direction is. I think there's going to be a lot of focus on social spending, some of these longer-term structural reforms we talked about, but that's not really news, right? We've seen that in the 2024 government work report as well. So we could see a positive direction in that realm, but in terms of whether that's going to really change the outlook for this year, I don't think so. Yeah.
Okay, so cities come out with their projections, and I don't know what are your projections at Oxford Economics, but they're saying that we estimate a shave off of 0.6 basis points of GDP impact from the additional 20% tariffs so far this year, which means definitely it's not going to be around 5%, right? Even if they try their stimulus measures. But the fact of the matter is, how do you see the net impact? Because from what we're hearing from the Commerce Secretary in the U.S. is that they want a deal. The U.S. wants a deal. So maybe this is just rhetoric. Maybe this is just a narrative that they want to fuel and a negotiating tool tactic.
Yeah. No, for sure. I mean, from the Chinese perspective, if you look at how the PBOC is fixing the currency on the stronger side, it does seem from the Chinese they also want a deal. They also want to be on the trade talks table. In terms of the kind of net impact, the way we see it, 0.7 percentage point drag from the 20% tariffs so far from the Trump administration. Part of that will be offset by stimulus by about 0.3%, and part of that will be offset by a weaker currency by about 0.2%, so the net drag is probably about 0.1%.
But they're saying that they'll keep this currency largely stable, adaptive, balanced at these levels. We should not read too much into that.
I think that is. I think the currency has always been a kind of last resort tool that they can use. They may not be as willing to use that now, but we know that that has happened before.
But has it got any impact, though? Just by simply devaluing your currency, is that going to offset the 20% increase in tariffs on the goods coming in?
It's going to be quite hefty. You will need something like the 10% decrease.
Are they prepared to do that, though?
I don't think so. So it's kind of a marginal offset, really, to kind of lessen the pain, I would say.
And we also had Trump, shooting a shot across the bow just yesterday, saying that Japan and China cannot just rely on devaluing their currencies out of all of this. But I just want to, and of course I should just also say, when he talks about Japan, they have so far been sheltered from the tariffs, but of course no one is safe in the current environment. David, talking of tariffs, from an investment perspective in China, I mean, how sheltered is the Chinese market from tariffs, given that, we've seen this rodeo before, so China to a certain degree has already tried to take steps to reduce its dependence on US trade, with the China plus one or China plus many strategy of diversifying operations and supply chains elsewhere, but also their financial, military and technological might and clout is really expanding.
Well, you're right, but I think, from an investor's perspective, I've always maintained that it is always better to stay out of trouble than to get out of trouble later. So you always have to have a look at China and say, there are risks involved here. And am I prepared to take those kind of risks as an investor? Let's not also forget that there is a whole wealth of companies that you can invest in. Sure, the Chinese market has gone up quite significantly over the last couple of weeks, and people are piling in there and saying, I want to buy those shares, I want to buy shares.
Do you think that's been justified? What do you think's got those animal spirits going again? Is it a deep seek hype, or is it something else that you think has got people's juices flowing?
I think DeepSeek has been a catalyst for people saying that, yes, there are alternatives to American artificial intelligence. There is something there. But again, if you invest there, you have to understand what the risks are, because the Chinese government is very capable of changing its policies overnight. And so whilst at the moment they are very supportive of AI, they could change tomorrow, in which case you will be left holding the baby. And then you will say, how do I get out of here? And let's not forget, you need a liquid market. And if nobody's buying your shares, you're stuck with them for a long time. That's not a good position to be in.
Indeed, indeed. I'm also looking at more lines that are coming out right now from the Reform Commission. They're talking about, okay, first and foremost, I do want to mark what's happened with the yuan midpoint, because it's come in at the strongest level since Feb 21st, at a time when we're talking about retaliatory tariffs from China on U.S. goods. So that, I think, is rather interesting to note, because we've been all talking about the currency devaluation and the currency strategy that China may adopt in the wake of rising tariffs. The other thing that is really interesting that I noted is that the NDRC is saying that they will remove unreasonable restrictions in consumption. That's one. And that China is to advance stockpiling of strategic goods and construct storage facilities for petroleum, grain, cotton, sugar, meat, what have you, basically to ensure that there's price stability as well and there's enough supply. What do you have to say to that?
Well, the thing is, I don't fully understand what China is trying to get at, because they say they want to stimulate the consumers. They want consumers to go out there and spend money. And they're trying different ways, maybe some kind of fiscal stimulus to try and encourage those people to go out and spend. But the Chinese households have money. The Chinese households have a huge amount of savings. So why do I need any stimulus in order to encourage me to go out and spend? Give me vouchers or whatever to go out and spend on a new refrigerator. I have the cash already. So thanks very much for the voucher. I'll go out and spend it. And how is that going to then create those animal spirits that you're talking about? How is that then going to encourage people to continue to spend? I'll spend the voucher and then no more after that. It's not as that. China is not addressing the real problem. We all know where the problem is, and it's in the housing market. And it's refusing to address that one problem, because they say, well, that will create a moral hazard. If we actually go out and address the problem of the housing crisis, it means that we're bailing out the developers, and we don't want to be in that situation.
Louise, where do you think we are in the cycle of the housing market, and what kind of policies do you think are needed?
Well, I think we're nearly at the trough, nearly. But having said that, we are expecting that prices stop declining only in 2027. So we have
2027?
So we have 1 or 2 years more before we actually really reach the bottom.
How is the trough, my dear?
Well, we should see some
trough.
stabilization. Yeah, it's a little bit of a bathtub shape.
A U
recovery
shape,
here.
perhaps.
More than a U shape. But
So
I
we
think,
labor around these levels.
Exactly. You can see that the pace of decline in prices are already becoming a little bit more manageable, right? So they're still declining, but not as steep as they were before. And we've seen some recovery, especially in the tier 1 cities, in terms of home sales. How that might last, I think, is a question of how sustainable the supportive measures have been.
Louise, didn't they say that about Japan in the 1980s?
They did, yes.
And how long did it take for the Japanese housing market to recover?
Similarly, I think they're following the Japan model, right?
Yeah.
In terms of really dragging it out, dragging the pain out, so that you don't have a sharp correction, right? You have something that's a bit more
Louise,
managed.
it took 30 long years it took
Do you think
Japan
China
to get
will
out.
mirror sort of the lost, I don't want to say lost decade, because it was lost decades. Is China mirroring shades of the lost decades that we saw in Japan?
I think if we look at the behavior of households and the behavior of businesses in terms of, instead of spending, they are trying to deleverage. They're trying to pay down their debts. That's very classic Japanese behavior in the 1980s. So there are worrying signs of that. That's why I think there is this haste to really pivot towards things like AI, things like high-tech, advanced manufacturing. How that will play out, I think finding that new growth driver and really managing the event risk that comes from the old drivers that have really pretty much, systemic
But that happened
risk.
in Japan also. I mean, let's not forget that in Japan, they had the housing crisis. But at the same time, Japan also had a huge export market. It was able to export its technology. It was able to export electronics. It was able to export cars. So Japan also had that.
But China has a big market to consume all of its technology and to consume all of what it is doing in terms of innovation in AI, no?
Provided people are prepared to spend.
And provided there are good adoption rates, right?
Yeah, that's a fair point. That's a fair point.
And certainly in a nod to what's going on with the deflationary environment in China, just getting back to, shades of Japan, they did, of course, lower their CPI target to around 2% from 3% as expected, because they were really loath to do that for a while, weren't they? Is that a meaningful shift then?
I think we can't read too much into the inflation target. Okay. The fact that,
I'm not convinced, Louise, because, inflation tells you that consumers are not spending. You get inflation when consumers are spending money. But if consumers are reluctant to spend, then you actually sort of end up with this deflationary pressure coming in. So
I agree, yeah. I think with regards to the target, however, we should, because of the deflationary pressures that are in the economy that are unlikely to go away anytime soon, the target really doesn't mean much. It's really more, I think, in practice in China, more of a ceiling, acceptable ceiling, rather than the midpoint that we see in other economies. So a lowering of that, I think, is an acknowledgement of the disinflationary pressures in China. But in reality, the CPI print is going to come in much lower than 2%. I would say our forecast is for 0.4%.
And that told you that consumers aren't spending.
Well, that tells you about the nature of the stimulus as well, right?
Yeah.
It's on the supply side. It's not really stimulating the kind of consumer spending that you would have wanted.
It is on the supply side, which is why PPI is so deep into deflation. One more line from the NDRC: will regulate business practices in online selling and especially product live streaming. Now, there's been this brewing bromance between the administration and the techies, right, the technologists, very quickly because we need to rush into a break. But it also seems like at the same time, the regulators are saying we're not going to give you a free hand. So contradictory messages there.
Yeah, so why would you invest in Alibaba? Why would you invest
because
in...
the stock is up 54%, their numbers look good, there's growth there.
That's the worst reason to invest in something.
You don't chase growth in the equity markets? What are you saying, David? You buy growth companies. Anyway, please carry on, 30 seconds.
Yeah, the point is, that doesn't convince me because, it's got to be sustainable over the long term. And as I said, policies can change overnight. And that, I think, is the danger. I would sooner buy Starbucks than Alibaba.
Let me get to you, David. Another thing that has come out of the NPC is that China is going to boost its defence spending by 7.2%, matching, of course, last year. And also, Premier Li Qiang at the NPC says that China will firmly advance the push for reunification with Taiwan. As Sri was saying, saying, we've had an economy that's been sluggish for 3 years. We've now got a US president who may or may not be counted on to defend Taiwan in any event of advance from mainland China. What does this all mean for defence stocks from an investment point of view?
You know, first of all, I'm glad I'm not in charge of the Chinese budget. And secondly, I'm glad I'm not a politician either. Because I would say, why spend 7.2% on defence when you have a big problem with the housing market? I would much rather direct that money to the housing market and trying to solve that. And
but maybe it's a case of look over here, don't focus on your problems in the economy, let's create a diversion over here.
You're absolutely right. It's all smoke and mirrors. I mean, you have a huge problem. It's almost as though your house is burning and you're saying, oh, let's go and put out that cigarette over there, right? Because let's not worry about the big problem. The big problem is the housing market. If they want reunification with Taiwan, you have to do it peaceably. In other words, you have to ensure that your economy is strong enough so that Taiwan wants to join you, not try and force them to be part of your economy. And I think that is the issue here. And as far as defense spending is concerned, we're seeing that all over the world, Mandy. I mean, I was looking at Singapore the other day. ST Engineering, which is a defence share, I mean, its shares were up quite significantly.
Record highs for certain European defence and aeronautical.
BAE Systems over in the UK, Rolls-Royce. I mean, everybody is so concerned about what is happening in America and the spillover effect that could happen around the world. And I am a little bit concerned because I think that when you have a problem, and back to your point, look over here. In other words, if you have a problem domestically, try and create unrest elsewhere. And it is sometimes,
It's a very risky strategy, though, isn't it?
But a lot of people do it, and a lot of countries do it. Russia's doing it because Russia has domestic problems. So let's go and start a war somewhere else and deflect people's attention from what is happening domestically and try and sort of get this gung-ho spirit going on. I'm very concerned about this. As an investor, I am worried.
Right, no, play the nationalism card. But I just want to talk a little bit about what Mandy highlighted earlier on in terms of having dry powder, right? Louise, you look at the reserve ratios and they've come down drastically. I mean, they're less than half now, less than 6%, about 5.5% whereabouts. And they're still talking about cutting reserve requirement ratios. They're still talking about cutting interest rates when the effectiveness of these tools is actually not playing out very well in terms of spurring economic activity and creating that credit impulse where people want to go and take loans from the banks.
Yeah, exactly. So if we look back into the last 2 years since they started the current easing cycle, the actual money that's been created into the system, the M2, the money supply, as we like, is 80 trillion. In a 130 trillion economy, that's massive. So there's a lot of liquidity onshore. On the other hand, you look at credit growth. Aside, if you strip out government bond issuances, you strip out government-led credit growth, the underlying pace of credit demand is actually quite weak. So how do you spur that, right? Again, confidence. How do you spur that? Really encouraging people to take out loans. I think that is the challenge, right? I think the alternative is if you were to keep your rates where they are, then that sends a signal that perhaps you're not as committed to easing. Then that creates a counterintuitive impact on activity. So I think their hands are tied. They have to continue to show that they are easing, even though the transmission mechanism is probably quite impacted right now.
Again, I mean, where you actually sort of go down to zero interest rates, and then you have negative interest rates in order to try and discourage people from saving and saying that.
Well, Governor Pan is quite clear in his assessment that he thinks that the current rates are still too high, right? Again, it's too high because your economy is in deflation, right? So your real rates are very, very prohibitive. So they have to cut.
This point that came across, which is the 2-year government bond yields, because we know that yields have been falling as more and more people have been finding safety in Chinese government bonds, now hitting its highest level since October 2008. The 2-year government bond yield hitting a level of 0.83%, which is the highest level since October 2008. What is that telling you?
Well, I think that tells us that, investors
Can they absorb all these bond issuances?
I don't think so. I mean, I think the problem is not in the financing. The problem is in spending it. So the question here is not how much they can actually how much powder they have. It's more where is that powder going to go, right? And I think when it comes to yields, PBOC has really gotten itself in a bit of a tight fix. It's trying to keep currency stable, is essentially embarked on a soft targeting of yields onshore because of the rush towards the bond rally that's happening onshore, and I think that is impeding its ability to carry out conventional monetary easing. Of course, the debate is whether that's effective, but if your traditional policy lever is not even working, then how are you going to stimulate the economy?
Let me bring up some of the things that have been coming out of the NPC with regards to improving the lives of Chinese people. For example, improving the social security net, helping people to have babies and to be able to pay for those babies, things like providing childcare subsidies, gradually making preschool free, things like that.
Elderly care as well.
Yes, elderly care as well, and also improving access to mental health. I mean, all of these things are incredibly important, and it feels like for many years we've been wanting more of this. Do you feel like we're getting what we need, or is it still not going far enough?
Well, I think it's a step in the right direction.
I think it's marginal, Louise.
It is marginal, but it's still better than where we were last year, I would imagine. The reality is, it's not just about support. I think we've heard a lot of rhetoric around the silver economy, right? Providing smart home technology, healthcare, elderly care. That is a recognition that demographics is going to be a real drag to the economy, not just Chinese policymakers think in 5-year terms,
Structurally,
right?
one of the biggest headwinds
to play out.
Exactly.
They have an immediate problem. Those kind of things are nice to have over the long term.
And they should stay. Yes, they should stay.
They should stay in place. You're absolutely right.
Yeah.
But I think they also have a problem with youth unemployment.
Yes, which is more cyclical as well.
Exactly. And I don't see how pointing towards this artificial intelligence is going to solve the problem. If anything, AI is going to actually create more unemployment.
Reduce jobs.
It reduces jobs.
I'm sorry, graduate, your job has been taken by a robot.
I think there is caution on that, right? So if you think about job displacements, I think they're going to be very careful about managing that, right? Yeah. Which is why when we think about DeepSeek, when we think about these homegrown models, there's a lot of animal spirits around that. But in terms of adoption to the broader economy, I don't think it's going to be rolled out as quickly as maybe some of the developed markets would, right? Because of how
Tony
weak it is.
Han from WeRide, which is basically this business that runs autonomous transportation vehicles, he told us on air that the pace of AI adoption, innovation adoption, has to be managed in a way where you have replacement first, then displacement. So I think that was
to upskill and reskill the current working
before the layoffs
population.
start. Yeah. So I think that's very important. I know we're talking about the gray areas and the areas where China needs to improve, right, in due course. But this is a $19 trillion economy. We can't take our sights away from that. It has come to a level where it's maturing, right, as an economy, and still growing, let's say, 4.5%, 4%, at $19 trillion, 4%, with a population base, which is, people can say aging demographics and all of that, but it's still 1.4 billion, right? Is it really all gloom and doom?
I don't think so. I think there are huge opportunities in China. And as an investor, you look for some of those opportunities. And the kind of companies that I like and I invest in China are, for instance, the insurance industry. Because I think that is one of those things that you can't do without. If you are a homeowner, if you are a consumer, a household in China, you have to buy insurance. And so there are many insurance companies in China that will probably do well. I think the banks will do well, partly because they are supported by the Chinese government. So we're not going to see a bank failure in China in the same way that we saw over in the West. I mean, that isn't going to happen. And I think the consumers in China, there will be companies such as Tencent, such as Alibaba, that will probably tap into. I mean, You're absolutely right, Tanvir. I mean, there's over 1 billion people in China that you can sell to. It's a huge market. It's 3-4 times the size of America. So if you pick the right kind of companies, those companies will thrive. So even though an economy may not be doing well, there will be companies within that economy that will be able to benefit shareholders, that will be able to deliver the growth that shareholders want. But like I said, you always have to be careful because policies can change overnight. And all those people that invested in many of those companies, like Tencent, and then suddenly you find the government policy has changed and they don't want people doing online gaming anymore. That company just crumbled, literally overnight. But just beware. Have some exposure to China because you can't ignore it. In the same way, Tanvir, have some exposure to India as well because, I mean, that is another a growing economy. So I spread my investments all over the place.
I'd like to maybe broaden the conversation from the Chinese economy to some of the other economies that China has increasingly relied on for their supply chains and operations, manufacturing bases, etc. Because obviously, when we had the original Trump 1.0 and the the various tariffs and ensuing trade war, then we saw a lot of Chinese companies make efforts to, for example, set up shop in Vietnam, Thailand, even Mexico. Mexico, of course, now is in the tariff firing line, so that's become a little bit more murky. But as Chinese manufacturers in particular are all scrambling to adjust as fast as you can adjust a supply chain to the new tariff policies, which economies do you think are going to benefit?
Well, I think we see more or less of the winners that we saw in 2018, 2019. Vietnam, Thailand, Philippines, to a smaller extent, Indonesia. These are the economies that we've seen over the last 5 years being able to essentially rely more on, for better or for worse, rely more on Chinese manufacturing inputs, right? So there is the case of them importing more Chinese inputs into their manufacturing processes. And then there is another case where the Chinese companies are actually setting up their production supply chains onshore in these economies. Now, from these economies' perspective, depending on the job outlook, depending on the labor market displacements, it may not necessarily be a positive thing, right? But we have seen the Chinese being a lot more forthcoming in terms of their overseas investments. So that trend will likely continue. And I would say that the adjustment that you talk about, much of that has probably already happened.
So everything that you said on insurance, there are multiple lines on what they're doing for the insurance sector and to boost insurance schemes for long-term care. This is coming out from, again, the NDRC. So I don't want to go into the specifics, but they're also looking at a reinsurance. No, that's Australia, sorry, that's another line. But a fair amount is being done on the insurance front. So that I do understand that you see that as an opportunity set. What about the new technology space? And what I want from you, Louise, is the contribution new technology can make, investment into new tech can make to the overall growth and productivity in China. But what I want to understand from you first, David, is, aside of Tencent, the broader Chinese tech, nuclear energy stocks, right, EVs, new technology, how do you play that theme in China? Because it has run its course. I mean, we're talking about Alibaba gaining 54% year to date. Yeah.
If you take the playbook from BYD, for instance, BYD doesn't sell a huge amount of cars over in America. I'd be surprised if they sold one car in America because of what is going on. But BYD is a very successful EV company. Why?
Doesn't it sell the most EVs worldwide? I mean, way trumping Tesla.
Correct. And the reason is because they go, if we can't sell in America, we can sell to the rest of the world. And I think this is something that we need to remember, that sure, I mean, America is a huge market, but ultimately it's only 300 million people. There are over 7 billion people in the world. So just because one market is closed to you doesn't mean that the rest of the world isn't open to you. And I think if you have a look at a company like BYD, it's saying, I can sell my cars in Singapore, I can sell my cars in Europe, I can sell my cars in the UK, I can sell my cars anywhere in the world. I don't need America. And I think this, is going to be the problem that America is going to face, that many companies will say, okay, so you slap tariffs on my goods coming into America, I'll go somewhere else. And then I will just sell my goods elsewhere. And they'll follow the BYD playbook and say, I don't need to sell to you. I can do pretty well without you. And I think that is when the Trump administration will find that they've shot themselves in the foot, because they're disadvantaging their own people from getting good quality cars from China that are cheaper than what you can produce in America. And Americans are going to have to pay over the odds for American-made cars, which is going to be inflationary.
Yeah, I've heard that point before as well.
People who are disadvantaged will be American households, not those companies
the US
outside.
Consumer.
The US consumer will pay the price.
Very quickly on growth from new tech.
Well, so we're expecting AI-related investments to actually raise GDP, in the later half of this decade by about 0.1 percentage point every year. That compares to our estimates for the U.S., which is about 0.2, 0.3. So really, still a fraction of the gains that we see in the U.S., and much of that has got to do with the more cautious stance around adoption, the more cautious stance around how that might play out in the Chinese economy.
Wonderful. It's been a really great conversation. We really appreciate the fact that you've sat here all hour with us and chewing over everything that's been coming out so far from the NPC in Beijing. Thank you very much to David Kuo of The Smart Investor and Louise Loo of Oxford Economics.